Good morning, everyone. I like your nice outfit, your earrings, and your necklace, Yaroa.
Stop it now and say it again when we are alone, H. de Boer. By the way, I like your Pizza Guy t-shirt. In the latest session, you promised to give us an example explaining how to measure inventory subsequent to initial recognition at the lower of cost or market under the LIFO method.
Okay, the example is, Tier and the company accounts for its inventory using the LIFO cost method. The following is its inventory information at the end of the fiscal year. Historical cost is $100,000. The current replacement cost is $82,000. The net realizable value, NRV, is $90,000. And the normal profit margin is $5,000. You are required to 1. Determine which amount represents the market, the current replacement cost, or the ceiling or the floor. And then, 2. What is the amount to be used for measuring the inventory, the historical cost or the market amount? You are also required to 3. Determine what journal entry is to be made if the market amount is below the historical cost.
As you taught us earlier, under the LIFO method, inventory is measured at the lower of cost or market, where market is the current replacement cost subject to certain limitations. To answer the first question, the current replacement cost, CRC, of $82,000 is not higher than the net realizable value of $90,000, the ceiling, as required by the statement of rules, but CRC is lower than the net realizable value reduced by the normal profit margin, the floor, of $85,000, $90,000, minus $5,000, while it should not be lower as required by the statement of rules. Thus, the amount to represent the market is the floor of $85,000. To answer the second question, because market amount selected of $85,000 is lower than the historical cost of $100,000, the inventory is reported in the balance sheet at the market amount of $85,000. To answer the third question, the write-down of inventory of $15,000, the difference between the historical cost of $100,000 and the market amount of $85,000, is recognized as a loss in the income statement. The journal entry to be made is as follows: debit loss from write-down of inventory for $15,000 and credit inventory for $15,000.
All your answers are correct. But I want to draw your attention that measuring inventory under the IFRS is different than under the GAAP.
In what aspects does IFRS differ from GAAP in connection with measuring inventory?
The differences between IFRS and GAAP in measuring inventories are 2. 1. Under IFRS, inventories are measured at the lower of cost, or net realizable value, NRV, regardless of the cost method used. Under GAAP, inventories are measured at the lower of cost in market when LIFO and retail cost methods are used, and at the lower of cost and net realizable value when FIFO and average cost methods are used. 2. Under IFRS, a reversal of write-down of inventory may be made but not above the original cost, and NRV is assessed each period. Under GAAP, a reversal of write-down of inventory recognized in the annual financial statements is prohibited in the subsequent periods.
If IFRS is applied to the same example mentioned above, the inventory is measured at $90,000. Is that correct?
Yes, using the data from the example above, net realizable value of $90,000 is lower than the original cost of $100,000. Thus, the inventory is reported in the statement of financial position at its NRV of $90,000. The write-down of inventory of $10,000, the difference between $100,000 and $90,000, is recognized in the profit and loss. The journal entry is as follows: debit loss from inventory write-down for $10,000 and credit inventory for $10,000.
What do you plan to deliver in the next session?
We will discuss measurement of inventory at the lower of cost and NRV under GAAP.